In this video, traders and investors, we're going to look at how the average investor can make money in a wild market. Stay tuned. Hey traders and investors, a very warm welcome to you. So how can the average investor make money, or trader make money, in this wild market conditions, or in wild market conditions in general? Now, you need to approach wild market conditions with a very, very cautious attitude. But there are some things that we can look at that you may not be aware of that can help you guide your strategy, your planning for the day ahead, whether you are looking to scoop up some bargains in a bit of a bear market, whether you are looking to take some profits from a little bit of bounce, whether you're looking to grab something on the short side, whatever it may be. There are some kind of broad things that we can do to help guide us a little bit better. Okay, so the first one is use the time zones to your advantage. What do I mean by that? So if you're trading the US, have a look to see how Europe traded. Have a look at how the DAX traded, how the FTSE traded, how the Euro stocks traded. That is going to give you a little bit of a guide as to potentially what could happen in the US. In other words, did they start lows and rally to highs? Have they kind of done a little bit of chopping around in the open and now they're pushing to lows? What's the structure of the day? Now, that might not mirror and match what's going to happen with your next opening session, whether you're going from Asia to Europe, Europe to US, US to Asia, whatever it may be, but it's going to give you a little bit of a guide as potentially how things could trade, so you can start to structure and frame your plan around it. Now, other thing to do is, because things are so volatile and so crazy, potentially using the open and the close to your advantage is a big win. What I mean by this, so at the open, if you have extreme panic at the open, you've got several days of selling, the final day of selling, the open is often a really sweet spot opportunity to grab some longs. When you've got literally a gap down situation, 2 or 3 moves, it's gap down, there's lots of panic, there's low volume, everyone's slamming to the downside very early on. Often that will be the low for the day. Not always. Obviously, you can get continued selling, and we've got to manage risk here. We don't know there's no kind of free money in trading, but very often you'll get that. The open, you get extreme levels that often aren't seen again for the rest of the day. So that's an example. You get that heavy selling, aggressive selling, prices are spiking down, you can scoop up some stocks, scoop up some bids, and then the rest of the day ride it out, potentially taking profits at the end of the day, or holding for a multi-day run if you think that's the end of the flush. Same with the upside as well. You've seen a bit of an upside move, and then it kind of really exaggerates itself in the first kind of 15 minutes, half an hour, whatever it may be. That might be an extreme. Of course, manage the risk. If it continues on over the next hour, you need to ditch the position, but it's something you can allocate time, resources to see if there's opportunity there. Same with the close. The close will often going to get a price spike. It's a way to take advantage of it. Perhaps if you bought something at the open, you get a price spike into the close in a down market, or you get an extra flush into the close. Generally, we're going to get that little bit more stretching in the close than we would do during normal day, because people are just getting a little bit more keen to get orders done. They want to dump those longs if we're pushing to the downside. They want to kind of dump those shorts if it's pushing to the upside, or pushing to whatever it may be. You get that little bit of a stretch, so use that to your advantage, whether you are taking profits or whether you are entering a new position. Now, obviously be careful and cautious entering a new position into the close, because you've got the gap risk, especially with stocks. Not so much if you're trading futures, you've got that overnight session you can trade, but if you're trading stocks, being very careful that you're aware of that gap risk. So take advantage of those. And actually, from a pure kind of cognitive load perspective, focusing on the first hour, the final hour, and forgetting what happens in between can help you if you kind of feel a bit overwhelmed, or even you set some alerts perhaps for during the day, but that can help you focus your energy into the parts, or into the time period, should I say, that will be most useful for you as a trader. All right, the other thing to do is to look at the pre-market and overnight futures as a guide. So pre-market is going to be what the stock is trading pre-market. If you're trading the NASDAQ, you're going to be able to see kind of where the stock is trading. Is it up or is it down? What's the general consensus of it? But whatever you're trading, you can look at the overnight futures as a guide. So what do I mean by that? Do we have the futures up a lot overnight, which is going to indicate the Dow or the NASDAQ or the S&P 500 is going to gap up. So the stocks are going to gap up with it. So once you start to know that, you can, not to say you can't just make free money off that, but you can start to structure a plan based on that gap up. Do I want to take those profits into that? Do I want to be careful chasing that? How do I want to play it? So you can start to plan a bit more rather than just seeing the stocks open and being surprised and going, oh, I didn't realize they're going to gap up. This is going to give you a bit of a guide. And also how they've traded. What's the sentiment? So perhaps the futures have ripped up overnight. Dow's ripped up 200-300 points and now it's come back down. It's only up 40. Maybe that's giving you a clue that actually people are using that as an opportunity to sell futures to hedge, and perhaps they're going to see more selling as they sell stock and then unwind. Who knows? But the idea is that you can see if the futures, overnight futures have been very, very quiet, perhaps you can extrapolate that out for the day and say, you know what, the day's probably going to be very, very quiet. I haven't seen much of an overnight futures range. So something to look at there. Being aware of company news. If you're buying something, you wanted to hold it for several days, if you're an investor looking to make a little bit of money in this opportunity, in this wild market, never, ever, ever ignore the underlying news, because it often can be exaggerated in bull or bear markets and wild market conditions. And obviously, don't forget, companies sometimes are going to have to take some extreme measures to combat this, because this doesn't come from nowhere. Often, you know, market volatility comes from some kind of catalyst, and potentially that catalyst is affecting the business, how the business is run. So being aware of company news that's scheduled, perhaps you don't want to have a position on because of that gap risk, because of that extreme risk. Being aware and having some sort of alert when news is coming out on it, so that you're not caught out unnecessarily. So you know and you're aware and you're comfortable with taking that risk. All right, the other one is using limit orders. This is a way of kind of dampening down that volatility risk. So you see the things, markets swinging wildly, stocks are swinging wildly, you want to buy it, put yourself a limit in. Put yourself a limit a little bit further away than you think. You might just catch that little stretch, and then you've got a nice cushion in that gives you opportunity to kind of build on that position for that stock to build on that base that you've got from that little spike in limits. So that's quite a good way of doing it. You're going to miss a few, but you'll get those little springs, because you get a little spring extension, should I say, because very often these wild markets, it's swinging back and forth, and if it just catches your bid, then you're in a good position. And obviously if it catches your bid and carries on through it, you can afford for your stock to be a little bit wider because you've already caught it quite low. So that's something to look at in these wild conditions. Obviously when it's quiet to the market, you miss more, but when it's a little bit more active, those limit orders will just snag those little flushes in move. And the final thing is stay small. Keep safe, stay small, keep the risk managed. Don't go crazy and start piling to stuff. Think it's a great bargain. Even if it is a bargain, it could do 3, 4, 5 more days of downside and become even more of a bargain for you. So being cautious, scale into positions if you need to, manage the risk, come out, reassess. Market sentiment rules all. 80% market sentiment, 10% sector sentiment, 10% stock sentiment. So if the market is getting hammered, doesn't matter how good the stock is, it's probably going to struggle. Try to gauge your buys on those extremes, little pops up, little kind of things, and get in tune with the flow of this bigger wild market moves, and you can make a little bit of profit from it and boost your trading account. All right, guys, thumbs up if you like this kind of stuff. See you in the next one. Take care. Bye-bye.